Okay, thank you. I didn't, on the second day, expect quite so many people here. You're laying on the risk. But I thank Olivia for inviting me. It was an opportunity to take a look at a topic that I've been involved in for quite a long time now in a longevity symposium that David Blake and I work on. But the topic today is a little bit different from what I've done for the past decade or so, because I'm taking a look at defined contribution plans as well as defined benefit plans. And I know a lot less about defined contribution plans, except from a personal level. And so you'll see a little bit of that personal level come in, I think, with a little worry about just what does it take to make one of these defined contribution plans actually work and work well for you. So, longevity risk, its implications for retirement security. I want to take a look at, if you can see it, longevity risk, of course, comes in, and it will come in indirectly with respect to the defined contribution plans. Financial risk, of course, is always involved, and we'll do some simulations, as you'll see. And a bit about securitization. The securitization will come into play with some hedging more in terms of the defined benefit plans than with respect to the defined contribution plans. But certainly looking at defined contributions makes me think more and more about the securitization, which would actually be nice to see. Actually, if in 1935 the whole social insurance bill had gone through, we'd already have longevity bonds that individuals would be able to purchase. It was part of the original package that went to Congress, but unfortunately didn't make it through. Once we've noted these three pieces, then I want to talk about defined contribution scenarios and some defined benefit scenarios by taking a look at some simulations. Longevity risk you already know much about from the other speakers that have already talked today, so I'm not going to go into any detail here. I am going to be concentrating on the trend risk, certainly when it comes to the defined benefit plans, and that's really the way that we've begun to think most about longevity risk. It's that we don't know what the trend is going to be, and if we get the trend wrong, then we need some hedge to cover that possibility. Longevity risk in the U.S. has been noted to be about $2.2 trillion. Swiss Re has estimated that globally we're looking at around $21 trillion. So these are risks that, these are values which are very large. So the capability of trying to hedge these risks, we think, really belongs in part in capital markets. Okay, the financial risks angle. Funds transferred forward to retirement are exposed to financial risks, as we all know. And we're taking a look at three different types. We've got the financial market, and for modeling purposes, we'll take a look at the S&P 500 as the equity portion, bond index, the Merrill Lynch corporate bond index as the bond, and then the 3-month Treasury bill. So those are the three assets that we'll be using in simulations. The return dynamics of the first two assets at each time is going to be described by a Brownian motion process with a compound Poisson process. That's well accepted, I think, in finance, and so we'll use those processes in order to do some simulation. And then the 3-month Treasury bill is going to be described by Brownian motion also, and we'll do some simulation there in order to generate the returns on these three different kinds of assets. The parameters of the processes are first estimated from historical data in the paper, and I'm not going to go to that table, but we are looking at approximately the past 20 years and then generating the parameters of these three processes in order to do the simulations going forward. Based on those simulations, then we can put any portfolio that we like together, and you'll see the results of those portfolios. I also wanted to take a look at another case, not just the historical case, because I'm not satisfied that history tells us much about what's going to be happening in the future, and I'm an economist, so I'm also a pessimist, and I want to take a look at what if things go really bad. I mean, we're looking at weather, and I think we've all noticed that the weather pattern is a lot more variable than it ever has been in the past, at least in my memory. And in fact, the same thing could be true of financial markets. If it became true, then we would start seeing a lot more volatility. And so rather than just looking at the base case, I wanted to look at another case in which we doubled the parameters so that we have a lot of volatility in the market. Then, as you can imagine, that makes life difficult for these portfolios, but just how difficult does it make it? It would be nice to be able to quantify that. And so we'll do that in the base times 2 case. Securitization. Mortality securitization involves the transformation of pure risks into speculative risks. We all know about the transformation into capital markets. We've seen, for example, I used to be the Swiss Re professor in Nottingham, and so I always looked to Swiss Re. But Swiss Re was the first to put a mortality bond together in 2003, and there have been a number of issues of that type bond since then, and that market has been growing. In 2010, they put together the Cordis transaction, which was almost a longevity instrument, not quite, because it had life insurance as well as annuities in it, and so there was a natural hedge built into the instrument. And then if that natural hedge wasn't good enough, then the hedge with the instrument would kick in and cover the extra. Other instruments include, as you've heard in previous sessions, buyouts, buy-ins, longevity options, Q forwards, longevity bonds. This is a figure put together by Guy, and we've seen it in other sessions, and so I'm going to move forward. The longevity risk transfer market is getting bigger. Okay, just a few words on scenarios. We want to put together asset returns, and so we're simulating those. As I said, we want to go for 1,000 paths and 58 years long on each path, because we're only taking longevity up to 123. Might have to do that farther, but minus 65 at retirement, so 58 years. Although retirement now, of course, is 66 for the beginning of the baby boomers and then 67 for the later baby boomers. We are seeing the first edge of the baby boom retire. Okay, for defined contribution plans, investors with DC plans are the ones that are exposed to longevity risk and to financial market risks, and we want to consider those investors. I wanted to take a look at TIAA-CREF, but I want to just touch on TIAA-CREF because they have a life cycle fund portfolio, and they specify what the equity investment is and what the bond and cash investments are over time. And those do change slightly over time until you're about 75, when they get locked in at about, I think it's 40% equity, 40% bonds, and 20% cash. But in the process of doing this, I want to take a look, this may be a bit different than usual. I want to take a look at the sustainable length of retirement. So I'm going to be looking at the length of retirement based on how much you want to draw from the account. And I also want to take a look at the value at risk and the CVAR on those sustainable lengths. So if you do wind up in the tail of the sustainable length distribution, for example, just what can you expect in terms of a length of retirement portfolio out in that tail? One of these links takes you to the TIA CREF site. And, okay. We report the mean, the VAR, and the CVAR. We also report failure rates on those portfolios. And in the base case, with no inflation, we come up with a failure rate. And this failure rate is failure if you fail with the portfolio to sustain at least 30 years of retirement. With the base case, we get about a 7% with no inflation. It jumps up dramatically with inflation. With the base times 2 case, as you would expect, it's going to go up, but it does go up to 97%. So we're looking at some real problems if the volatility of the market changes substantially. Okay, I did want to take a quick look here at other portfolios. Don't worry, it'll come. And this is just to give you an idea of what's going on here. If you, I'm an economist, so it's me first rule, and I wanted to take a look at $1 million portfolio initially, and then drawing down at $75,000 a year. All right. We want a little bit of money when we retire. But if you look at that, all of the elements here in the upper portion of the triangle are indicating the sustainable years. And if you want the maximum sustainable year, then along the left margin, you're looking at equity. Along the top margin, you're looking at your position in the bond fund. And then the difference when you, and the rest of it is simply the T-bills. So as you're going along this triangle, or going along this off diagonal, you're covered with the bond fund and with equity, and you have nothing in the T-bills. So we've got to stay above that line. And the point here is that if you look at the TIA CREF portfolio of 40%, 40%, and 20%, then we're good for 10 years. The best that we can do here, withdrawing $75,000, is 23 years. So that's just a bit over my estimated life at retirement. Not particularly comfortable. And then if you take a look at what happens if you go into the VAR and the CVAR, the expected sustainable period for your portfolio out on that tail is only going to be 5 years. So you're looking at some real difficulty if the market becomes very volatile and you wind up with bad returns. Oops. I'm not going to have time for more than one of these probably, but I wanted you to see what the distribution of sustainable lengths looks like. This edge is equity, this edge is bonds, and the remainder, of course, is what you're looking at. This is the CVAR that we're looking at here, and you can see that with more and more equity, it drops off rather rapidly, as it also drops off with bonds. And it was the 5 periods that were located in here. This was the position all into T-bills if you really want to make the most out of your portfolio, even in the tail. Okay, then I dropped back down to $40,000, and the story is much different. With $40,000, you can sustain the portfolio there much more easily than you can with the $75,000, as you would expect. We did take a quick look at what if we go with 40% with 40% equity, 60% bonds, that is trying to mimic the TIAA CREF, and withdraw $40,000. Then we're looking at a fairly nice case in the base case of only 4% probability of failure. It's much higher if you get into 2% inflation, which is the historical figure. If you add the volatility, then you're again in big trouble, even at 40,000. We went in then to define benefits. We took a look here. We're shifting perspectives now. With defined contributions, those with the plans bear the risk. And so those individuals are responsible for their own portfolios and for covering themselves. With the defined benefit plan, of course, it's the pension provider that's got the responsibility for the longevity risk, and so we looked at a different objective here. Here we wanted to minimize the variance of the underfunding risk that's facing the pension provider, subject to some constraints. We're looking at the manager minimizing that variance of underfunding, subject to constraints on the expected underfunding, the short selling, the size of the tail of the underfunding distribution. So now we have that a different distribution that we're looking at. And we've got the constrained minimization problem. We run through the basics to get the optimal portfolio for the base case and the base times 2 case. But then we consider 2 possibilities for hedging. With the hedging, we have these results. We do get a portfolio, and we are looking at what can happen to expected cost as we change the size. The H is for what portion are we hedging. The delta is for how costly is this. So if you're taking a look at no hedging cost and you're hedging either 10 to 15%, then you can see that the expected total portfolio cost is going down, and the CVAR is also going down. And so that in fact happens for all the possible G parameters. I haven't gotten a chance to get into this, but we took a look at different trends, and as you change the trend and make mortality improvements faster and faster, then the results are going to be similar in terms of your ability with these instruments to affect the expected total portfolio cost and the tail risk. We're able to cut the tail risk, and that was really the chief objective in taking a look at this problem. I'm not going to have a chance to go ahead and get to the other case in which we're looking at a different hedging instrument, but the results are the same. If you hedge with options rather than hedge with partial buyouts, then you'll be able to achieve essentially the same results. They're not going to be identical results because, and those are in Table 13, they won't be identical results because with these longevity options, you're simply covering tail risk there. And so you're not going to be reducing risk as much as you do with a partial buyout, where you're shifting assets as well as longevity, as well as liability risks. So the cuts in the size of the risk are going to be smaller, but you are able with these instruments to cut the tail risk. And so in concluding, since I'm out of time, we looked at buyouts, we looked at options. We have other instruments that exist, and these instruments are increasingly being used for defined contribution plans where the individuals bear the risk and the longevity and capital market risks If we look at these risks and we allow for the possibility of increasing volatility in the markets, then it becomes increasingly apparent that we need more instruments to cover this risk. Raymond and Olivia have a nice paper on ways in which these risks can be shared that's worth taking a look at, and we will in this paper. For the defined benefits plans where the pension fund bears the risk, the longevity and capital market risk, the analysis shows that the underfunding risk can be cut by hedging with partial buyouts or with options, and I'm sure that we can do the same thing with Q forwards. But there, the market needs much more development than it's seen so far. And with that, thank you.
Thank you. Thank you, Richard.